It all began with the astonishing failure of Silicon Valley Bank, SVB, and since then the ripple effects have been felt far and wide. Just last Friday, the 10th of March 2023, U.S. authorities swooped in to seize the bank's assets as panicked depositors withdrew their money in record numbers, fearing for the bank's stability. This catastrophic event marks the largest U.S. bank failure since 2008, and now financial regulators worldwide are scrambling to contain the fallout and restore confidence in the global financial system. Welcome back to our channel. In today's video, we're uncovering the jaw-dropping truth behind the Silicon Valley collapse that nobody is talking about. We're going to explore the hidden side of this story that no one else is discussing. So if you're ready to uncover the truth, make sure to hit that like button, subscribe to our channel, and don't forget to turn on notifications to stay updated on all things tech and finance. Let's take a trip down memory lane, back to the early 80s when a friendly game of poker between two buddies ignited the idea that would give life to Silicon Valley Bank, or SVB as we know it. Founded in 1983, SVB's main ambition was to gather deposits from investor-backed startups and eventually expand to offer a variety of services to support clients even beyond their early stages. Do you know what's fascinating? Despite facing challenges in the early 90s due to real estate loans, SVB not only persevered but also branched out, financing more than just tech. They even got involved in the wine industry. When the dot-com bubble burst in the early 2000s, many banks crumbled, but not SVB. Under the guidance of CEO Ken Wilcox, the bank stayed true to its own core mission, serving IT firms. Now, SVB has evolved to provide private banking services and has even spread its wings internationally with offices in Bangalore, London, Beijing, and Israel. But the real turning point for SVB came during the 2007-2008 financial crisis. The federal government stepped in, lending the bank $235 million through the TARP program, and guess what? SVB paid it all back in 2 short years. This just goes to show how dedicated SVB is to its customers and its constant drive to innovate in order to better serve the tech community. And it didn't stop there. Under the leadership of CEO Greg Becker, SVB joined forces with the Shanghai Pudong Development Bank to back startups in China, even going so far as to use the renminbi currency. With a track record like that, it's easy to see how SVB became a true heavyweight in the banking world. Now, let's dive deeper into the story of Silicon Valley Bank and explore what exactly went wrong. SVB was the go-to bank for tech startups and established tech giants alike. Many of these innovative companies and their hard-working employees trusted SVB with their money, and some even took out loans from the bank. By December of 2022, SVB's assets would have skyrocketed to over $200 billion, making it one of the top 20 largest banks in the United States. But then, things started to unravel. In 2022, the Federal Reserve made a bold move, rapidly raising policy rates from nearly 0% to a whopping 5% within a year. This shift had a ripple effect across the financial landscape. Tech stocks and digital assets were sold off, cryptocurrency exchanges closed down, and companies in need of funds found it increasingly difficult to secure them. Amidst this turmoil, SVB and other banks saw the value of their existing bonds plummet. Usually, banks could just wait for bonds to mature and be repaid the principal. However, many banks, including SVB, had opted for longer-term bonds because shorter-term securities weren't yielding much during the previous low-rate period. Sadly, these longer-term bond holdings became virtually worthless due to the Fed's abrupt rate hikes. As news of the bank's struggles spread, customers started withdrawing their money en masse. To keep up with the demand, SVB had to offload $21 billion in loss-making longer-term U.S. government bonds and mortgage-backed securities, resulting in a staggering real loss of around $1.8 billion. When word got out that SVB was planning to raise money through an IPO on March 9, 2023, the situation only worsened. Influential players like Peter Thiel's Founder Fund advised all their portfolio companies to close their accounts with SVB. That's when the FDIC stepped in, aiming to protect depositors and ensure as much of the bank's assets as possible were returned to them. But there was a catch. This move could potentially wipe out the value of shares owned by SVB Financial Group, the parent company of the bank. Now, it's essential to understand what made SVB so unique among financial institutions and how that uniqueness contributed to its downfall. There were three critical differences. First, SVB's deposits were more susceptible to interest rate fluctuations than its assets. Second, its customers were primarily large businesses, which tend to be more price-sensitive than small retail customers. Lastly, SVB was unique in the proportion of its total assets invested in securities, a staggering 55%. Most banks have extensive portfolios of variable rate loans, which means interest payments increase as rates go up. Thankfully, the FDIC swooped in, announcing that insured depositors of SVB would be able to access their funds by Monday, March the 13th, 2023. This was a huge relief for depositors who were covered by insurance, who were also reassured that SVB's branch offices would start working again under the watch of regulators. And as per the FDIC's standard insurance policy, depositors are covered up to $250,000 per bank per account ownership category. But what about the uninsured deposits? Well, there is still some uncertainty surrounding 89% of the bank's $175 billion in uninsured deposits as of the end of 2022. But fear not, the FDIC is working tirelessly to find a bank willing to merge with SVB over the weekend, which would provide a lifeline to those uninsured depositors. Meanwhile, SVB Financial, which is the parent company of Silicon Valley Bank, is actively looking for buyers for its other assets, such as investment bank SVB Securities, wealth manager Boston Private, and equity research firm MoffettNathanson. SVB Financial is sure that it can find the right buyers with the help of investment bank Centerview Partners and law firm Sullivan & Cromwell. Although it's a challenging time for SVB stakeholders, the FDIC and SVB Financial are taking positive steps to find solutions and potential buyers. Rest assured, we'll keep you updated as the situation unfolds. But let's take a step back and look at the bigger picture. While the collapse of SVB has raised concerns about the stability of the banking system, there's little reason to worry about a domino effect of financial institutions failing. With SVB's assets representing just 0.91% of all the U.S. banking assets, its failure is unlikely to have a significant impact on the other financial institutions. However, SVB's demise does bring light to the vulnerability of many banks' investment portfolios. As the Federal Reserve has indicated that interest rates will continue to rise, U.S. banks' investment portfolios could keep losing value, potentially affecting their ability to stay in business. However, most banks still maintain enough capital to handle these losses. This is largely thanks to the Fed's efforts after the 2008 financial crisis to ensure that the financial industry could weather any storm. So for now, the banking system remains stable. While we can't entirely rule out further financial failures, the likelihood of such an event is relatively small. And even if it does happen, the system is well prepared to handle it. In the midst of all the uncertainty surrounding Silicon Valley Bank's future, an intriguing rumor has surfaced. Could it be that Tesla's enigmatic CEO Elon Musk might swoop in and save the day by purchasing the bank? This idea gained some serious traction on March 11, 2023, when Musk himself stated that he would be open to considering such a move. One of Musk's followers on Twitter suggested Twitter should buy SVB and become a digital bank, to which Musk responded, "I'm open to the idea." As you can imagine, his comments went viral, sparking a wide range of reactions from the online community. Some folks believe this could be a significant opportunity for Twitter to enter the banking world, while others took the chance to make lighthearted jokes about keeping Musk preoccupied. When we think about what happened to Silicon Valley Bank, it's important to think about what it means for the whole financial world. So here's our thought-provoking question for you. What can we learn from the failure of SVB to make sure that the banking industry is strong and stable even though the economy is always changing? Share your thoughts and ideas in the comments section below, and let's have a meaningful conversation about the future of finance. If you enjoyed the video, please give it a thumbs up, and thanks for watching.